Pending home sales sliding more than 7% in August, their biggest drop since last year, and the Kansas City Regional Fed survey declining in September. My next guest says it could all spell trouble for the Fed. Let's bring in Aditya Bhave, senior economist at Bank of America Securities. Aditya, welcome. What kind of trouble?
Good afternoon. Thank you for having me, Kelly. So basically, our base case is that the Fed does another 25 basis point hike in November, but the risks are growing that they won't be able to do that. And there's a couple of ways that could play out. One is if there's a potential government shutdown, they just might not have the data for September in time for the November meeting, in which case we think they'll basically punt on a hike in November. The other possibility is that economic activity could slow meaningfully in the early part of Q4. There's a bunch of risks that are potentially building up. The UAW strike would be the biggest of those, but we could have a government shutdown as well. And there's sticky energy prices and student loan repayments. So if you get a perfect storm of all of that and you're tracking closer to 0% GDP growth for the fourth quarter, the Fed will probably decide not to do that last hike in November.
Absolutely. And Steve, there's another risk as well if we don't get the data. I thought Torsten Slok summarized it well from Apollo this morning. He said the real risk to the economy and to financial stability is if weak economic data is not met with falling long-term interest rates, right? Obviously, like what's happening in Germany right now. But the problem is if we don't get the data, we're not going to know what that reaction function looks like.
I think that's a definite risk and a definite possibility, Kelly. We'll see how long the government shutdown lasts. But, you know, Kelly, I've made sort of a little bit of a career of telling people that issuance doesn't matter, because it really hasn't. The markets have been able to, this global markets, able to take down the issuance from the Treasury. I don't think that's any longer the case. And I think the point you're making, something that Ray Dalio maybe was talking about, is you could have these high yields among flagging economic growth. And the question becomes whether or not the Treasury gets a better hold on what's happening in the market, starts to understand that all of this issuance, the president needs to understand this, the Congress needs to understand this, that you are going to keep paying unless you start to give some visibility to an end to this issuance to the Treasury market.
Exactly. And Aditya, over at MKM this morning, Michael Darda was basically saying he thinks the coming downturn will trump the deficits. In other words, he'd be a buyer of bond yields at these levels because he just thinks the weakness that we're heading into, like it always does, will end up driving yields lower.
Right. So as our rate strategist said, there are risks around the deficit, which could drive yields higher. However, if the economy does slow down, I guess one silver lining is that we'll worry less about higher structural rates, higher neutral rates, because then we'll have evidence that higher Fed rates did impact the economy eventually, and that should help bring yields down to a certain degree.
Although I know that you guys...
Aditya, I disagree a little bit on that. Just a little bit. I mean, I think the problem with the next downturn, which hasn't happened yet, and maybe we forestall it, but how much ammunition does the Fed and does the Treasury, how much will they have to combat a downturn? I think we might be a little bit, you're kind of on your own on this one, in that, yes, there'll be some rate cuts on the short end, but also I don't think you can look for massive fiscal stimulus or assistance in the event of another downturn, assuming it's shallow.
Absolutely agree on the fiscal side. The Fed probably has some ammunition to cut. How much ammunition they have will depend on how their views around neutral rates evolve. But on the fiscal side, there is a serious concern there. I agree with you 100% that if there is a downturn, there's probably not a lot of room for stimulus.
Aditya, fortunately, you guys have been in the no downturn camp lately. Any of the recent data or the fact that the fourth quarter looks like it could be a slump, is that lending you towards revising that view lower once again?
Yeah, it is a point of concern. A lot of the headwinds for the fourth quarter still look likely to be temporary, so I'm less concerned about that. That looks like a soft patch, not the start of a recession. But if you look at the second quarter revisions, consumer spending revised down from 1.7% to 0.8% growth. That's concerning, and particularly the revisions were large in services, so housing, transportation, recreation services, those were revised down meaningfully. So that's something to watch for. Does the consumer have less momentum than we previously thought?
Absolutely. Last word, Steve?
I have a quick question for Aditya, real quickly, Aditya. Because that revision down in the second quarter, does that mean the retail spending numbers are going to be revised down? And does that mean the third quarter numbers, which are sky high right now, are actually a bit lower if that jumping off point for the second quarter was indeed lower?
Retail sales were already revised down for June and July, so that's what we will expect to see reflected in the consumer spending numbers for August tomorrow. But these revisions for the second quarter won't affect retail sales.